Hello, everyone. We'd like to welcome you to the GASB 84 Revisited and now GASB 97 webinar presented by Ide Bailey.
Good day, everybody, and we're glad you're with us today. We have people from all over the country online with you today. I hope you had a great July 4th holiday and are staying healthy. My name is Eric Berman. I'm a partner with the Boise office. Today's topic is GASB 84 fiduciary activities. This is the fourth webinar on GASB 84 that we've done since the issuance of the statement back in the dark ages. I can't believe that was January 2017. It seems so long ago. We've also done a bunch of articles on GASB 84 on our website since then as well. This focus is not for the faint of heart. In the words of the now former chairman of the GASB, Dave Vout, GASB 84 is a monster. He's right. The statement has upended GAAP that's been in place since prior to the GASB's existence. It may run counter to current policies, procedures, and in some cases, laws. But we have a twist today. Late last month, GASB issued statement number 97, which holds the record as the longest title of any statement issued by the GASB. Now let's see if I can say this in one breath. Certain component unit criteria in accounting and financial reporting for Internal Revenue Code Section 457 Deferred Compensation Plans and amendment of GASB statements number 14 and 84 in a supersession of GASB statement number 32. Whew. Now, before we all start thinking that GASB 84 is being overturned completely, well, sorry, folks, you didn't get your wish. But some aspects of GASB 84 are clarified by the issuance of GASB 97, and in some cases, things that are or were potentially fiduciary activities may not be reported as fiduciary activities as a result of GASB 97. For those of you who have implemented GASB 84, in certain cases, some of the decisions may need to be revisited, especially in the case of reporting deferred compensation arrangements and other employee benefit plans where your government may not have control. So let's get started. Today's agenda, the first part of GASB 84 details decisions needed to recognize a component unit that is fiduciary in nature, also known as a fiduciary component unit or FCU. Some of these decisions are changed by GASB 97, so we need to be a little bit careful going through those. The next part of GASB 84 discusses the non-component unit recognition of fiduciary activities, but focusing on control. GASB 97 also has an impact on those control decisions. I'll then discuss looking at your agency fund activities and how they do not equate to custodial funds. Next, I'll talk about some implementation ideas for GASB 84, some guidance that's available, and then your questions. So indeed, GASB 84 is a sleeping giant. The statement contains some of the most unclear language I have ever read in a GASB statement. The result of the interpretation of that language may impact processes, policies, and procedures that have been in place since prior to the GASB. GASB 84 not only impacts fiduciary component units such as pension and OPEB plans, but it also impacts external investment pools, foundations, and endowments. And it also impacts pension and OPEB arrangements that are not component units, private purpose trust funds such as cemetery trusts, and funds that may best be termed the wild, wild west, agency funds. Governments have routinely included a bunch of activities within agency funds, all of which may need to be re-examined. When we get to the implementation ideas, I suggest that you look at agency funds very carefully as they may change the most. Look at them first before you go anyplace else, because a lot of decisions may be predicated off of those changes in the agency funds, including certain instances where funds have to go to governmental funds or business type activities. And if the funds go there, that means that there could be a situation where you have a new major fund. As a reminder, there are 4 paths within GASB 84, potentially resulting in a fiduciary activity. Remember, this is within GASB 84. I haven't discussed GASB 97 as of yet. The first path is whether there is an existing component unit relationship that is providing pensions or OPEB. The most common of these that is a fiduciary component unit is a PERS plan relationship to a state. The second path is whether there is an existing component unit relationship that does not provide pensions or OPEB. Common relationships include foundations of public institutions of higher education or healthcare that are already component units. Others include external investment pools of states and very often external investment pools of counties. The third path is whether there are any post-employment benefit arrangements that are not component units. Now, this is the area that may be greatly impacted by GASB 97, so let's stay tuned on that one. If not impacted by GASB 97, the more common scenario is a single employer defined benefit plan, typically found at a city or some other local government. If it is held in trust, it is likely included as a pension or other employee benefit trust fund prior to GASB 84 already. If not held in trust, it is likely included as an agency fund prior to GASB 84. The final, here, I went too far too fast. The final path are all those potentially fiduciary activities, including investment trust funds. Again, typically investment pools, endowments, and other fiduciary funds that are not component units. As an example, in my town, this includes our conservation trust fund that includes a park which contains a pond a few blocks from where I'm sitting at right now, that many millennia ago was under a glacier. Endowments for our libraries and schools, and any other clearing accounts for uncleared checks and deposits in transit. All of those would be under that bucket number 4. Any of these may or may not result in fiduciary activities under GASB 84, and now they must be further analyzed when implementing GASB 97. So to begin with, let's go down path number 1. Now, we're going to assume that there's already been a decision that there's a component unit relationship that could be a fiduciary component unit. But now we need to go a step further. Many practitioners skip this, though there needs to be a component unit relationship automatically if it's fiduciary. And again, we need to go a little bit further, as in general, not always. If an irrevocable trust is in place for pensions and OPEB, they are deemed to be legally separate. But this does not always mean that there's a fiduciary component unit relationship, especially with a defined benefit plan. There is a financial burden if the primary government is legally obligated or otherwise assumed to have the obligation to contribute to those plans. But stay tuned a little bit later when I get to the points about irrevocable trusts. We have to though start as to whether or not we do have a component unit. So do we have a component unit? We talked about this during webinars earlier this year. To have a component unit, there needs to be a legal separation and accountability. Without those two aspects, there's no possibility of a component unit. So let's say we do have legal separation. Then there are two paths with a decision point at the point of whether or not there is a voting majority. And I can circle that on the screen. We're talking about here, let's get our pen going. We're talking about this path right over here. Whether or not there is a voting majority. Because again, we already have legal separation. Now hold that thought as on voting majority, as your answer may change due to GASB 97 in a few slides. So let's say we're going to say yes, that there is a voting majority. Then the next decision is there some form of financial benefit or burden, or is there some form of imposition of will? If not, then you're not at a component unit, you are down below here in a related organization. Again, we need both. If the answer is yes to either tree, we're at a component unit, and then we need to figure out if it's a fiduciary component unit or not, and you're down here on the left-hand side of the screen. But we have a problem with GASB 84 and component units. As governments were implementing GASB 84 across the country, they made inquiries to GASB. Wait a minute, I have a relationship with a potential fiduciary activity. No, I don't have to go down the path of a majority equity interest because the provisions of GASB 90 do not apply. But wait a minute, the potential fiduciary activity does not have a board. It is legally separate. There's a trust. So what should I do? This is where Scotty on the Enterprise says, Captain, the shields are buckling. Help indeed it was and is needed. Well, now we have GASB 97 to the rescue. And it's long titled to potentially save us from this problem. And a problem it is, as many relationships with potentially fiduciary activities have this issue. Legally separate organizations due to a trust, but no separate board. It's just a relationship. So what does GASB 97 do for these relationships? First, a potential component unit relationship needs to be analyzed. If there is a potential component unit, if the primary government performs the duties that a government board performs, such as managing the assets or keeping the books or administering the funds somehow, some way, absence of the board is the same as appointing a voting majority. How does this work? So let's say we have a defined benefit plan, and I emphasize the words defined benefit plan held in trust at a city. The city council instructs the city treasurer to serve on behalf of a board. And in that case, then indeed, the function of the city treasurer is serving the same as a governing board. And by fact that the city treasurer is appointed by the city, you happen to have a voting majority. But again, we're talking defined benefit plans held in trust. So there are major exceptions within GASB 97. GASB 97 excludes this step if a potential component unit is either a defined contribution pension or OPEB plan or some other employee benefit plan, including certain, and I'm emphasizing the word certain, but not all Internal Revenue Code Section 457 plans. That word certain is absolutely vital. Keep it in mind. Given this change in GASB 97, the only thing left for this potential component unit analysis, and again, we need that existing potential component unit, and it's the same component unit analysis that we've been doing since 1994, and it's just been updated every so often, the latest being GASB 90. So once we have this potential component unit analysis, the only relationships left include defined benefit pensions and OPEB, external investment pools at states and at many counties, and other non-pension or OPEB potential component units. But we must test that component unit relationship first. And if we don't have a component unit relationship, GASB 84's provisions are still there. So once we test that component unit relationship, second, there needs to be that relationship already, and then finally, the financial burden decision is only applicable to defined benefit, pension, and OPEB plans administered through trusts. If we don't have a trust, it's unlikely you have a potential component unit relationship. But you still have a potential component unit relationship for other potential fiduciary activities, so don't forget about those. And again, we're talking investment pools and so on. So keep those in mind as we go forward. Let's go back to our tree and see where GASB 97 makes those changes. Again, there must be some form of legal separation. And the best way to do so is using an irrevocable trust in the case of benefit plans. The majority equity interest provisions, again, those are the ones over here on the left-hand side. These do not apply in our situations with fiduciary component units because equity interests are mainly for private companies and so on. And we've talked about these in webinars past, and we'll talk about them in the future, I'm sure. So again, we're over in the center of the screen here. Therefore, we need to default to the voting majority decision. But remember, the voting majority decision only applies to defined benefit plans or perhaps external investment pools. So let's say we have one of those relationships. Then do we have a financial benefit or burden? The answer will be yes if the plan is held in trust. And then we figure out how we report. So, okay, what if we have a defined contribution plan relationship? Well, we need to skip the voting majority decision. To be a component unit that's fiduciary in nature, there would have to be some form of fiscal dependency, or it would need to be deemed to be misleading to exclude. Both of those elements are pretty rare in practice. Hold on a second, I'm going to take a drink of water. So again, if you happen to have a defined contribution plan, you don't go down here, you go to the right. You're going to do a little arrow. And you have to have some form of fiscal dependency criteria, or it's misleading to exclude. So again, you might not get there to have a component unit relationship. So a lot of us forget what it means to have an irrevocable trust. And I like to remind people about it. As GASB project manager Lisa Parker calls it, you need to have IDP to be a trust, not ADP. As you can say ADP for assets, yes you can. I is for the word irrevocable. D is for dedicated benefits, and P is for protection from creditors. More succinctly, the contributions must be irrevocable. You can't take contributions out other than to pay benefits or pay plan expenses in accordance with the plan document, or perhaps provide loans depending on the type of plan. The second piece is the assets must be dedicated to providing benefits. Now, this is straight out of the IRS's exclusive benefit rule. And for those of you keeping track, that's Internal Revenue Code Section 401A2. Now, that rule is absolutely key. It requires, hold on a second. Man, the pollen is killing me here. It requires that a qualified plan be maintained for the exclusive benefit of employees or their beneficiaries, and that under the trust instrument, it'd be impossible at any time prior to the satisfaction of plan liabilities for any part of the principal or income of the trust to be diverted for any other purpose. The paying of administrative costs to manage those benefits falls also under this exclusive benefit rule. The asset must be legally protected from creditors, meaning in a divorce situation, bankruptcy, legal trouble for the government or beneficiary, the assets can only be used to pay for benefits. In a divorce situation, a qualified domestic relations order or a quadro from a judge is allowable, and that doesn't mess up the trust. So without all three, you do not have an irrevocable trust. So keep this in mind. Now, let's get away from all that jargon. What does all this mean? As discussed in the summary of GASB 97, the requirements within GASB 97 will result in more consistent financial reporting of defined contribution pension plans, defined contribution OPEB plans, and other employee benefit plans while mitigating the costs associated with reporting those plans. Now, it could be that many of those plans may not be reported by the primary government unless, and I emphasize this, unless, the plan is administered in conjunction with a defined benefit plan, usually utilizing an Internal Revenue Code Section 115 trust, or when the government has control over the assets in accordance with GASB 84. Now, that Section 115 trust situation is usually in place in things like teachers' retirement plans or in employee retirement systems and so on. Those 115 trusts are very common. Now, the GASB does not have specific GAAP pertaining to Section 115 trusts, but in essence, they are in control because it would be misleading to exclude. We'll get to a discussion on control in a bit, but first, I'd like to hand it over to Nanette with our first polling question.
Thanks, Eric. So I'm launching the polling question now, so you guys should be able to see it popping up on your poll on your Zoom account. So you should be able to vote, but we'll read the question together. Government has a defined benefit plan, single employer. Board is 5 members, 1 active participant, 1 retiree, 3 appointed by City Council. Assets are held in trust with requirements of GASB 67. The employer contributes, no approval of budget, planned amendments by the government. Is it fiduciary activity or none? Or not? And it looks like everyone's starting to vote, so we'll give them a few more minutes.
I want to vote.
You want to vote? Oh, I should have clicked the button. Sorry, Eric. I didn't
No, that's okay.
Okay.
I don't want to bias the answer.
Okay, we're about 86%, so we're doing good.
Okay, how do we land up? Oh, that's a good split there. Now, in this case, the government appoints a voting majority, 3 out of 5 members. The plan is held in trust, and if we go back a slide or two, we remember our IDP mnemonic. It is a defined benefit plan. Notice we said defined benefit plan up here on top. held to which the employer contributes. And since the employer contributes, we have some form of financial benefit or burden. This is a fiduciary activity. And by the way, this is the first question in the GASB implementation guide to GASB 84. So this is one, if you said no, it's not a fiduciary activity, you may want to take a look at that question there and see if indeed it fits your situation. So let's get to the next here. Hold on a second. Come on. Let's go forward here. Let's get to our second polling question, Nanette.
Okay. So the second polling question, a state has a cost-sharing benefit pension plan for the benefit of all governments within the state. The plan uses an irrevocable trust. The board of the plan is independent and not appointed by the employer. The board alone has the authority to establish a budget and determine contributions. The employer contributions are made directly to the plan from all governments. So is it a fiduciary activity, non-fiduciary activity? State adds as a fiduciary component unit deemed as misleading to exclude.
Okay. So we got a split decision here as well. So in this case, again, we have legal separation, but a voting majority was not appointed by the state. There is a financial burden due to employer contributions, but no fiscal dependency. It does not, there is no determination of the plan's budget or contribution requirements. So in this case, it's not a fiduciary, but it could be included under the misleading to exclude provisions. So it really depends on where you are in terms of your own government. So either one of the bottom two probably would have worked. I would say in terms of the state, you're probably at the bottom because of misleading to exclude, but that is a decision made on primarily professional judgment. You know, but if I am a school district within the state, I'm not going to include the state teachers retirement system as part of my fiduciary component units. No, that's just a, you know, that could be just an outflow depending on how it's reported as contributions, or it could be a fiduciary activity in some way, shape, or form, but not really a fiduciary component unit. When you think about the relationship of a state to a statewide PERS plan, in nearly every situation I know of, the plan is included due to the misleading to exclude provisions of GASB 14 as amended. So again, this one here is also in the implementation guide to GASB 84. You may want to take a look at that. So here, I'm going to go back in and let's keep going. There we go. All right, back to GASB 84. If you are completely confused, let's get back into GASB 84 to figure out the rest of the story. Let's reset and remember that we've pretty much hammered paths 1 and 2, but now we're beyond those paths. Path 3 is there some form of pension or OPEB relationship that is not an existing component unit. And there are a lot of these that we'll talk about in a minute. Now, finally, path 4, are there any potential fiduciary activities that under current GAAP, prior to GASB 84, may include things like external investment pools, private purpose trusts, or agency funds? By program, we know the investment pools may include things like local government investment pools at state and various savings trusts. For private purpose trusts, don't forget prisoner commissary funds and potentially college savings plans. Prior to GASB 84, agency funds included, again, lots of different activities such as intergovernmental payments, potentially child support disbursement funds, payroll clearing and withholding, contractor check clearing, and similar zero balance accounts. For example, all of your warrant processing may have gone through there, in your check clearing, as I mentioned. All of these may need to be analyzed. And notice, I didn't even go down the path of student activity funds just yet. And we haven't even started there as of yet for all of my school districts and institutions of higher education on the call. We're beyond these fiduciary component units, but there may be pension and OPEB arrangements that are still out there. Now, they could be fiduciary if the government controls the assets and they are administered through a trust. And in this case, they could be either defined benefit or defined contribution plans. Or we have some form of situation where the government controls the assets and the assets are held for entities other than those within the government's reporting entity for pensions and OPEB, which are in an agency fund prior to implementing GASB 84. Now, this particular area of GASB 84 is among the hardest to understand. And it's simply because there are a bunch of double negatives that are in there. And we need to spend a little bit of time here. Just what are these types of plans that are held in an agency fund? For example, a common situation is when a group of governments form a defined benefit plan. One government in the group holds the assets, but to allow for flexibility, an irrevocable trust is not established. There's no component unit situation established. Due to the provisions of GASB 84 and control, the assets are a fiduciary activity of the other governments, and the controlling government is a custodian. That the amounts that pertain to the controlling government would be part of the government's own governmental or proprietary fund statements. Only the amounts pertaining to the other governments are in a custodial fund. So again, this is one of those things that's a little bit difficult to understand. But this word control, we're going to revisit this word control over and over again. And so let's spend some time there. It's important. In understanding the word control is difficult. Control is present if the government controls the assets of the activity. This occurs when the government holds the assets or can direct the use, exchange, or employment of assets to the specific or intended beneficiaries. Now, many of you are saying, well, wait a second. I send my funds out to insert the name of the bank and they take care of it for me. Well, guess what? Appointing an administrator doesn't matter. Restricting the assets doesn't matter. Now, what does the word use mean? The word use is described as the ability to expend or consume an asset for the benefit of individuals, for the benefit of organizations, or for the benefit of other governments outside the government's provision of services to them. A way to think about this is something that many of us gloss over or forget. There's a footnote in GASB 84, and it's footnote 5, and it's also contained in the basis for conclusions in paragraph B11. In footnote 5, it says, when a government appoints a designee to act on its behalf, the designee is performing the government's fiduciary duties and not assuming them. Thus, that means appointing a designee to act on a government's behalf does not alter the government's ability to direct the use, exchange, or employment of assets. The government is in control. So case in point, let's say you appoint the United States Bank or the Bank of the West or the Bank of the East to to manage an employee benefit arrangement. You're still in charge by giving them that contract. And since you've given them that contract, you have the ability to use, exchange, or employ those assets. But it does not always mean that you're in control. The board added footnote 5 to clarify that if a government appoints a designee to act on its behalf, again, the government still maintains the ability to direct the use, exchange, or employment. But the board also concluded that by eliminating the term administer, as it discussed previously in previous GAP, it would clarify that the selection of investment options or determination of benefits would not by themselves result in a determination that the government controls the assets. Now, what does that jargon all mean? It means that in many situations, if the employee or beneficiary has the ability to choose investments, it could be that the government does not have control. And let's break that down a little bit. This means that using a third-party administrator is perfectly okay. And in fact, it may be required by law or regulation or the plan provisions or so on. That's perfectly okay. But the government may need to review the additional provisions of control to determine whether a fiduciary activity is in place. And in the case of the situation where the employee or the beneficiary has the ability to choose the assets that are in there, employee or beneficiary may have control. Notice I'm saying the word may. It does not mean always. Okay, so what about other fiduciary activities beyond these plans? Remember, we're still at control. If we have control, then the next step would be, are the assets from different revenues other than the government's own source revenue? So what's own source revenue? Examples of our own source revenues could be taxation, fees, fines, and other inflows that the government is parking in a fund that may have been fiduciary under prior GAP to be spent in a future year. This does happen. When I was a deputy state controller, my state legislature decided to do this nearly every year. They had a bunch of unspent revenues carried forward from the prior fiscal year, and they basically put it in what they termed a trust fund to be named later. And under prior GAP, we called that an agency fund transaction. Under GASB 84, no way, unlikely. Second piece, are the assets for some other source than taxes or grants? But there's a major exception in there. If the assets are purely pass-through grants for which there is no administrative involvement or no direct financial involvement, then they might be a fiduciary activity. But in practice, many grants have some form of matching or level of effort or some form of accountability for disallowed costs. So it might be difficult to get to a fiduciary activity with that second point there. Then it's a fiduciary activity if just one of the following on this slide is met. So you have to have one of the previous slide elements, and then one of you have to have both of these slide elements, and then somehow, some way, one of these slide elements here. The assets are administered through a trust, and again, we talked about that IBD, or IDP, excuse me. And again, we talked about that a bit ago. The assets are for the benefit of individuals where there is no administrative or direct financial involvement. And as indicated here, in many situations, student activity funds might have administrative or direct financial involvement. Finally, the assets are for the benefit of organizations and others outside the reporting entity. Now, again, this one might be common as funds are being raised for not-for-profits, or in the case of municipal aid passed through from one government to another without some form of administrative or direct financial involvement. So this is where control gets dicey. If a government is holding assets for the benefit of other entities, such as other governments, if it is a group of investments like an external investment pool, well, guess what? Fiduciary activity. But if it was a defined contribution plan and the participants make their own investment decisions, unlikely fiduciary activity. And the same holds true all the way down the line here. In the case where investments are not held in trust, well, it could still be a fiduciary activity, but a custodial fund. The degree of choice is highly controversial. Again, it shows up in the basis for conclusions to GASB 84, and it does not show up in the codification. And a lot of people are saying, as they have implemented GASB 84, they're saying, well, I might as well call GASB. And GASB staff they say to you flat out, what they say is not authoritative, but they say if the employees have choice, then in essence, the employees or the beneficiaries have control. But where is that breakpoint? What is the level where the participant is in control? The only thing that we have written down is not in governmental GAAP. It's in an ERISA plan, and those plans have stemmed from the 1970s forward, and they're regulated by the U.S. Department of Labor. If the participant has a choice of 3 investments in such plans, then the participants are in control, not a fiduciary activity. But again, those provisions are not in governmental GAAP. We could use the definition of the word choice in the dictionary versus control, but again, not in GAAP. So we're left up with professional judgment in some cases. Now, in other cases, obviously pretty well spelled out within GASB 84. But here, in the word choice versus control, not in GASB 84, other than the basis for conclusions. I mentioned the jargon administrative involvement and direct financial involvement. Now, these provisions have been in GAAP for a very long time. They've been in GAAP since the 1990s, and they came out in GASB 24. And they've been copied word for word 60 standards later in GASB 84. GASB 24 was on pass-through grants like food stamps and EBT cards. Administrative involvement is mainly monitoring for compliance, determining eligibility. It's more than just being a rubber stamp. In essence, it's the ability to say no. Direct financial involvement is providing matching or level of effort, or somehow being held accountable for disallowed costs. For those of you, for example, who are receiving COVID-19 funds from another government, that other government that is providing you funds signed the original grant award agreement. And actually, they have to be reporting next week if they're coronavirus relief funds. They have to be reporting to the U.S. Treasury next week. That came out in a frequently asked question late last week, conveniently during the July 4th weekend. If you're a prime recipient, you have to do a filing to the Inspector General's office there. And the thing is, you could have administrative involvement by signing the terms and conditions of that grant award agreement and having to live under the terms and conditions of the Coronavirus Relief Fund. If that's the case, you might have to return the funds if there are disallowed costs. Now, again, that's pretty controversial and it's subject of another webinar. And certainly we've been doing a lot of webinars on COVID-19, not only in the government practice, but throughout all of Eide Bailly's practices. But if you are signing a grant award agreement and you are responsible for allowable costs, chances are you happen to have some form of direct financial involvement, even though you pass forward those costs to another government. So now we must think, based on all this, fiduciary activity or not. These activities are where some of the major decisions will be. And in some cases, they may be fiduciary and others not. And in the governments that have already implemented GASB 84, this is where a lot of the back and forth between our staff and the government went. A lot of back and forth on student activity funds, a lot of that back and forth on student club funds, a very important back and forth on payroll withholding and other agency fund activities. Now, again, some of these may be fiduciary and others may be not. And that leads us to our next polling question, Annette. How you
All
doing
right.
it?
We just launched it. So the city has a single employer defined contribution plan. Assets are held in a qualified trust. There is no board. All assets are managed by a third-party administrator. The employer provides a match of 2% up to $1,000 annually, and the employer has the sole ability to direct their own investments. Is this fiduciary activity or not?
Again, we have a split decision. Now, and I understand why, because again, this is highly controversial. So here again, we have a legally separate plan. Let's get rid of this. We have a legally separate defined contribution plan held in trust. Okay, it's a qualifying trust, no board. Remember, we now have GASB 97, and the employee has the ability to direct their own investments. Financial burden in this case doesn't matter. It's not a component unit and not a fiduciary activity, as the government does not likely have control. So yeah, there might be a match, but notice it says up to 1,000. Doesn't mean that the employer is automatically providing the match. And in fact, many general purpose governments are facing this exact question right now because of budgetary issues with regard to COVID-19. Do we provide our match or don't we provide our match? It might not be a fiduciary activity here, not a component unit, as the government does not likely have control. And again, we're talking defined contribution plan, not a defined benefit plan. Would we have a different answer if it's a defined benefit plan? Likely. Probably a fiduciary activity. And also in a defined benefit plan, chances are the employees cannot direct their own investments. I don't know of any defined benefit plan where the employee can direct their own investments. Usually they're professionally managed. But again, it could be out there. You never know. There might be a lot of flavors of these going on for sure. So hopefully that answers the question for you. So to sum up on control, and again, it's important that we spend a lot of time here. It's really up to the government making the judgment. Every government is different. So don't look at your neighboring government and think that if they make the judgment that they do have control, then your government must have control. Every situation is different. Don't make a mistake. Don't be a lemming and jump off the cliff. Let's just use similar fact patterns for different governments. Here we have a county investment function and a defined contribution plan with different potential results with each layer. Notice how having a trust is a determinant if something is a custodial fund or not. But the most important aspect may be the word choice beyond whether a trust is in place. Again, if the participants can choose investments in a defined contribution arrangement, absent any other facts, it might not be a fiduciary activity. So just be aware that different facts and circumstances could result in different situations here. So now we got to think a little bit more on own source revenues because, hey, we've beaten the heck out of control. Again, different facts produce different answers. So for example, if a city collects cash for a cemetery association that is not a component unit, both with a separate board, it's not own source revenue and is a fiduciary activity. But if a license fee is charged to businesses and shared with a state, then the government is levying its own fee and passing it on, not a fiduciary activity. It's not the same as the cemetery association. The same goes for prepaid tuition plans. Now, prepaid tuition plans are becoming less and less prevalent, and in some cases they're closed, simply because of the investments in the economics of college tuition. Prepaid 529 plans have a product or service provided by a state for a fee, and therefore that becomes own source revenues. So that brings us to our next polling question.
All right, so we have a municipal court collects fees associated with traffic tickets. The fees are determined by a state, not the municipality, sorry. The court collects and remits the fees monthly to a state agency. Assume that the court controls the assets and they are not from the government own source revenue. They are paid by the plaintiffs. Is it a fiduciary activity or not a fiduciary activity?
Yeah, these can be fairly common. They're essentially filing fees. Essentially, if you're going to plead your case because you were speeding up, in Annette's case, the 210, you're speeding up there, you got to go to the county and file and pay a filing fee to appeal your case, fiduciary activity or not. Again, a split decision. All right. So in this case, it is indeed a fiduciary activity. Let's go through this one more time. Yes, the fees are determined by the state, but the court, which is a local entity in this case, remits the fees monthly to a state agency. So it's essentially a pass-through entity. And you can also say, something, the court is a separate branch of government, maybe even legally separate. I've seen some cases where courts are component units. Assume that the court controls the assets, they're not paid from the government's own source revenue. And since they're paid by the plaintiffs directly, essentially those filing fees for going 94 miles an hour down the 210, past our Rancho Cucamonga office. Well, if that's the case, this is a fiduciary activity and it would be a custodial fund. So let's delve a little bit further into some of these other activities. Many have asked about student activity funds and similar activities such as booster clubs. There are tons of questions on student activity funds in the implementation guide to GASB 84. There were some in the implementation guide update for 2020 as well. And there are likely lots more coming because, again, as governments implement GASB 84, they're saying, well, what about this situation? What about that situation? And so on. And it's amazing how many different flavors of student activity funds and similar and that are out there. And one thing to be aware of, some state education entities have required filings on student activity funds, and they differ from state to state. So just be aware. So let's start off. Here we have a chess club that is not legally separate, and the club raises funds to pay for activities. The proceeds are held in a school account. The club is not legally separate, it's just a club. Therefore, GASB 84 decisions will need to be made, and if there's some form of accountability or decision-making by the teacher or administrator, I'm a little closer to a governmental activity than a fiduciary activity in this one, and here's why. The school district matches the funds, which is classic direct financial involvement. This could indeed be a governmental fund. And so again, if indeed there's some form of matching that is going on, chances are this is a governmental fund. Now, that becomes question 4.26. Again, this is basically the same question as the chess club, but now the school district matches the funds. And in that case, that's a direct financial involvement. And in that case, it is a governmental fund activity. Here, this could be a governmental fund activity. It really depends on some form of accounting and or accountability, embedded within the school teacher or school administrator. Here's some other ones. We have a fundraising event for a not-for-profit. And we're raising funds, say, for disaster relief. The not-for-profit, of course, is legally separate. We're talking about Feeding America or something like that. The proceeds are held in a school bank account, restricted solely for the disbursement to the not-for-profit activity. Since it's solely for the disbursement to the not-for-profit activity, that not-for-profit is legally separate, not contained within the reporting entity of the school district in this case. And so if that's the case, chances are it's a fiduciary activity. And as you can see here, it's also implementation guide question 4.28. So here's another one. Here we have a touchdown club, and this is question 4.32 in the implementation guide. The touchdown club is a legally separate 501c3. You find this a lot of institutions in higher educations. The club has its own board of parents, of players and supporters, sort of like the PTA. The club is not a component unit. The funds are not held by the school district in this case, or you could scratch out the word school district and just type in institution of higher education. And in this case, there's no control by the school district. It's not a fiduciary activity. And think about it in the, under the guise of, say, if you're K through 12, your local PTA, or if you're an institution of higher education, think about it in terms of your alumni booster club. I mean, yes, the alumni booster club may be buying uniforms and so on, or maybe funding the college coach or something like that, but it's not really in control of the institution of higher education, probably not a fiduciary activity. Now, again, facts and circumstances are going to be different from school district to school district, institution of higher education to institution of higher education. So you really need to be careful on this stuff. There are other activities that need to be analyzed. For those of you with printed copies or can write on the screen, circle this first one. This one is huge. It's a biggie. Payroll deductions and similar. That is not a fiduciary. And here, I'm going to do I'm having a little fun here with you. After all, when you talk about GAAP, you have to have fun somehow, some way. Not a fiduciary on those. Inmate canteen accounts and seized assets prior to trial, fiduciary. Pass-through taxes, fiduciary. These and many, many more are contained in the implementation guide. So take a look at this. And again, look at the implementation guide. The implementation guide's a little bit more authoritative than I certainly can be because it's been voted on by the board. but you may have a situation here, especially on payroll deductions, and we'll talk about that in a little bit when we get to talking about converting agency funds to custodial funds. And that brings us to our next polling question, Nanette.
Okay, a school district holds the funds raised by student clubs. The clubs are not legally separate from the district. There is no school board, no administration policy related to the club activities and how the resources are spent. An aggregated club account is used, but not in trust. Just disbursements are approved by each club facilitator, faculty advisor, who is a representative of the school district. The advisor may also reject or modify the spending at their discernment. So is it a fiduciary or non?
Yeah, pretty split down the middle. Well, here might not be a fiduciary in this situation. Again, yeah, they're not legally separate from the district, but there's no policy on this one. And there's a centralized account, and it's not in trust. And since there's a centralized account, not in trust, and there's some form of approval by the faculty advisor, who's a representative of the school district, and they can reject or modify the spending at their discretion. They're administering the funds, and they have direct financial involvement going on there, and administrative involvement. In that case, it sounds to me like the district has control, and it might even indeed be a form of a governmental fund or governmental activity. Now, again, not a fiduciary, but there are so many variations in this fact pattern. And in fact, there are 3 questions that are that you just change one word on this screen and it has 3 different answers. And those are questions 4.20, 4.21, and 4.22 within the GASB implementation guide. And so take a look there and see if you happen to have a situation where your student activity fund may match the situation. But in many situations, student activity funds may indeed be governmental. So back to our session here. So I'd like to spend some time talking about custodial funds, as the reporting of custodial funds is brand new in GASB 84. I think all of us need to put a Post-it note on our computers in big letters: custodial funds are not agency funds. Don't make the mistake of moving all agency funds into custodial funds. No, 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 no. It is not, they do not equal. In custodial funds, there's a further wrinkle. Assets do not equal liabilities. When we do our financial reporting, we're going to have a real profit and loss statement. Well, not a P&L, but you know what I mean, a statement of changes in fiduciary net position. There are some exceptions to reporting for business type activities where funds are being held for 3 months or less. Those will just be payables from the operating fund of that business type activity. External portions of investment pools not held in trust, those are also going to be custodial. Now, if we look at some typical funds that would probably be custodial in many situations, let's take a look at a few of them. Let's go back. Hang on a second. Intergovernmental accounts for taxes and fees, such as sales and use, property taxes, motor vehicle privilege taxes, collected by your say, State Department of Taxation on behalf of local governments, probably a custodial fund at the state. Motor vehicle accounts for taxes and fees collected by a Department of Motor Vehicles, pending distribution to counties. Yeah, probably a custodial fund. One that is very common: child support disbursement accounts for centralized collection and disbursement of child support payments. Yeah, that's probably a custodial fund, because certainly the folks receiving child support, they're well beyond your reporting entity. There's the problem. If some of the former agency funds are no longer fiduciary, what do? Well, there are three glaring problems in implementing the custodial fund piece of GASB 84. The first being, what's the beginning balance, as GASB 84 is to be implemented based on the period beginning December 15th, well, now 2019. That's due to GASB 95, which is what we talked about last month. There's this year delay that was put in by the GASB because of COVID. By the way, I mentioned at the outset of this session on custodial funds, by the way, if a material amount moves to a governmental fund as a payable, does the opinion unit and major fund calculation change? Again, we're moving as of the beginning of the year, the period beginning after December 15, 2019. So for you December 31st governments out there, you were talking January 1st of 2020 if you hadn't implemented GASB 84 as of yet. The second problem is, how do you adjudicate what activities and agency funds are purely custodial to remain in fiduciary activities? One of the problems we ran into in the governments that have already implemented GASB 84 is the agency funds are not purely agency funds. There are a lot of mixed activities and a lot of appropriation accounts under the agency funds. And so you had to go through one by one and figure out, okay, is this purely custodial or is this not custodial? And then what about our financial reporting systems? Can they handle the changes? Well, in most situations we've run into so far, the answer is yes, they can handle those changes. But in other situations, you might have some form of hard coding going on, and they may not be able to handle those changes. So I mentioned payroll withholding. Again, this one is a big deal. No, payroll withholding will no longer be a fiduciary activity, and the amounts must be restated as of the beginning of the period. But what is that number? Now, I know what you're going to do. You're going to say, okay, what is the amount of payroll withholding? What was that amount that cleared in the first pay period? As an auditor, yeah, I know you're going to do that. Is it going to be materially different? Perhaps not. But again, how did you derive that number? If the funds are going to go back to a governmental fund, remember there's a different measurement focus and basis of accounting. Agency funds were supposed to be full accrual, and governmental funds are supposed to be modified accrual. Now remember, I was a preparer for a long time, so I know what you're doing. Again, agency funds were supposed to be full accrual, and governmental funds were supposed to be modified accrual. Could some assets and liabilities be removed due to the basis of accounting change? Perhaps yes. Don't underestimate how complex this might be, especially if your government has been using a payroll withholding clearing account forever. Try to reconcile that account. It might be really difficult. Back about 20 years ago now, in an era when we were using Excel 97, when I was a preparer, I asked one of my managers to reconcile the payroll withholding account for a state. It took us 3 years to do it. And indeed, there was about a $24 million variance in there. But we did it. So reconciling that account would be difficult. And why would we reconcile that account? What amount do you put over into the general fund as your beginning balance? Now, again, you can back into it, and I'm sure it's going to be fairly stated in most of the situations, but not all the situations. Now, one interesting aspect of GASB 84, reporting fiduciary activities does not change all that much. You know, we've just spent basically the first hour and 15 minutes of this webinar talking about the accounting. We haven't really talked one word about financial reporting. And it's interesting that the fiduciary activities will not change all that much. Additions and deductions can be aggregated by source if they're meaningful. One big change is that investment income is going to be reported gross of this new account that is termed investment costs, not investment expense. Custodial funds can aggregate inflows and aggregate outflows as long as those categories are meaningful. So in your financial statements, don't just say inflows and outflows, and that's your only line in your custodial funds. The categories really need to be meaningful, especially if you have a lot of stuff going through those categories. A BTA that chooses to report resources in its own statement of net position should separately report additions and deductions. It's significant as long as those are significant. And you report those additions and deductions as cash inflows and cash outflows in the operating activities of your statement of cash flows. Liabilities in the statement of fiduciary net position may have some adjustment. The updated guidance is based on a presentment for payment. So what do I mean by presentment for payment? Let's say I am a school district employee and I am eligible to retire early, and because of an early retirement incentive program, and that was put in because of budgetary pressures. So I have an early retirement incentive program. I meet the criteria to retire. I present my papers. My papers are accepted. The amounts are approved by my local retirement board. Since my local retirement board approved them, I file my papers and I say, start paying up. That is a presentment. Now, does it mean that the entirety of the amount of money that I will receive for the entirety of the rest of my life, is that a liability? No. The amount that is the liability is the amount that's due and payable to you as a beneficiary. So let's take a look at the statement of net position. I just went through this. Let's just take a look at the statement of fiduciary net position. Again, not too much change except in this column right here, custodial funds. Now, here we have receivables, and here we have some form of other assets that are there. We have accounts payable, we have a due to other governments, and then, oh, by the way, down here on the bottom, we got net position. And that net position is restricted for individuals, organizations, and other governments. Now, again, not too many changes except in this final column. And this comes straight out of GASB 84. Now, let's take a look at this column here in the statement of changes in fiduciary net position. Again, look at the flows here, but also look over here. Here's my investment costs. Notice how it is separated. I have my investment earnings from all my activities up here. And I have a total investment earnings going down over here. But then I have this less investment costs, and I have my investment activity costs and my securities lending costs that are down here. These are going to need to be separated, and notice the terminology, the word costs. And then notice the terminology on the bottom, net investment earnings. So that does need to change, and if you happen to file in the GFOA's CAFR program, they're going to be pretty much sticklers on that terminology that's there. So let's go back and look at this custodial column. Notice how the aggregation is. Again, sales tax collections for other governments and miscellaneous are over here. That's a pretty good, split. Now, if there are other forms of taxation, you might have other additions going on here. And then we have our payment of sales tax to other governments. Now, notice the amounts are exactly the same. And that's going to be up to your individual situation going on. In many governments, they will be different because there's a time lag that does go on. But remember also that they need to be on the accrual basis of accounting. So in some situations, they're going to be exactly the same. So Here's where we have a net increase in fiduciary net position down on the bottom. And again, here is our fiduciary net position for custodial funds. Pretty much that's it in terms of our financial reporting. But wait, we still have some aspects to GASB 97 to go. Now, remember a while back, I mentioned this word certain when talking about GASB 97. Why did I do that? Well, Internal Revenue Code 457 plans have had some issues in reporting since the issuance of GASB Statement Number 32 in the late 1990s. Now, if you read the Internal Revenue Code, Section 457B, which is where our plans are for governments, there are other types of 457 plans out there, mainly rabbi trusts, for example. Section 457B describes these plans as deferred compensation plans. They are not defined contribution plans, they are deferred compensation plans. Now, most plans we run into in practice are just the employee withholding. But in some governments out there, they may have thought they were in control. While other governments thought that since the funds were employee funds, they're not in control. Those governments felt that they were not in control, they were just not even pension plans. And so we have had a lot of chaos since GASB 32 came out in the late 1990s. It was 1997 or 1998. And in fact, there's not much to GASB 32 other than investment withholding, investment reporting, if indeed you do report these situations. But in other situations, these are not reported. And so hopefully GASB 97 alleviates and ends this chaos. First, a 457 plan of any type, and again, there are multiple types, they'll need to meet the definition of a pension plan. So what is the definition of a pension plan? Now it's right here on the screen, and it's straight out of GASB 67. And it's the lettering in bold. And so if you want to dog-ear this, if you happen to have a 457 plan, and if you have a printed copy of this, you might as well dog-ear this page. So straight out of GASB 67, a pension plan is an arrangement through which pensions are determined, assets are dedicated for pensions are accumulated, and managed, and benefits are paid as they become due. Now, if a 457 plan does not meet this definition, it is an other employee benefit plan, and governments then need to rewatch this webinar, start over again, and figure out whether or not that 457 plan is in accordance with GASB 84 and needs to be reported. Now, if you've started over again and you've gone all the way back to those slides that say, hey, wait a second, I don't know if I have control. Well, guess what? You might not be in control. Now, if you're not in control of the 457 plan, chances are might not be reported, other than maybe some payroll withholding as a payable in your flows out to the plan. Might not be reported. And now again, for those of you who are public employee retirement systems or teachers retirement systems that happen to have 457 plans, well, probably not a teacher's retirement system, but certainly a public employee retirement system that has a 457 plan. If you happen to have a Section 115 trust, chances are you're in control under GASB 84 because by virtue of that Section 115 trust. Now, one major unanswered question with GASB 97 is, gee, 403B plans are kind of a lot like 457 plans, but a separate section of the Internal Revenue Code. What do we do with 403B plans, which are really tax-sheltered annuities? What do we do with those sort of things? And we happen to be a teacher's retirement system. Well, if we're a teacher's retirement system, you got a 115 trust there, chances are you're in control. But let's say you're a K through 12, you don't happen to have a teacher's retirement system, you're just, hired your local investment provider or some national investment provider, of which we have relationships with a national investment provider that happens to have a 403B plan. Then you have to go back to GASB 84 and say, gee, am I in control? And if the employee has the ability, or the beneficiary has the ability to make a choice in the investments in GASB 84, make a choice in the investments in the 403B plan, well, guess what? Probably not a pension or fiduciary pension or other employee benefit plan. Might not be fiduciary reporting in the statement of fiduciary net position or statement of changes in fiduciary net position. Now, will you have withholding and outflows to the 403B plan? Sure, but those are going to be in the governmental funds or business type activity. Now, there are a handful of 457 plans out there that are a defined benefit. Now, these are rare. If so, these rare plans would be reported just like a pension plan in GASB 68. In most cases, they would be defined contribution plans, but in extremely rare cases, they may be defined benefit plans. If there is a 457 plan that is a defined benefit plan, I'd like to really talk to you, as we have some work to do, as we'll talk about in a minute. In most situations, when I talk to folks who say that, gee, we have a 457 plan that is a defined benefit plan, what they might not realize is that when they go through the 150 pages of the benefit plan statements or the benefit plan setup, you might find a situation in there that there is a separate defined benefit 401A plan that takes the defined benefit piece, and then there's a separate 457 plan that happens to take the employee's piece. And in those situations, what you really have is a hybrid plan, and you have a DB side and a DC side. The DB side would land up using essentially GASB 68 provisions, and the DC side, or the 457 plan side, excuse me, would use GASB 84, and in this case, GASB 97. So since we talked to you last, there's been some other amendments to GASB 84 reporting that you may have missed. After all, we're all a little bit busy these days because of COVID-19 and so on. In this case, again, we're talking GASB 92 and now GASB 97. Now, if we have a fiduciary activity for pensions and OPEB, but we don't have a trust, how do we report it? Now, in this case, GASB 92, which is an omnibus standard, clarifies that all provisions of GASB 84 would apply, as well as the liability provisions. Now, before you jump out of your seat, know the total pension liability, because we don't have a trust, and know the total pension liability or the total OPEB liability on the face of the financial statements. Does that get reported in a fiduciary fund? No. Just the amount of the liability that is due and payable to our participants or sponsors. If there is a DC plan that is a fiduciary activity, by the way, let me go back. The total pension liability and the total OPEB liability, that's still on the face of the financial statements, but within the fiduciary fund, the amount that's paid over to our beneficiaries, that's just the amount that's paid, that's declared as a liability. If there is a DC plan that is a fiduciary activity, the reporting of the plan will be the same as any other pension or employee benefit plan, obviously as appropriate. Okay, now putting it all together, how do we go about and implement GASB 84? Now GASB 97. Well, the GASB in its benevolent wisdom gave you an extra year for GASB 84 if you haven't implemented already. But that year is now largely gone, especially for you December 31st governments out there. For June 30th governments, well, you got a present for July 4th weekend. You are now late. You had to start last week. GASB 97 for component unit adjustments, given there is relief in reporting, those aspects are implemented now. You're not going to, and once you make the component unit determination, you're done. You don't go any further. And in many cases, again, probably not a component unit situation. For 457 plans, those have a year more to go, but remember, most of those may not be reported as there may not be a form of control. Now, there were two dangling implementation guide questions, and we talked to you about this late last year that were suspended. Actually, we talked about these earlier this year, and I think we sent out a communication as part of an article from the GASB. Questions 4.3 and 4.5 in GASB Implementation Guide 2019-2, those were suspended earlier this year, along with a third question. Now, with the issuance of the Implementation Guide 2020-1, those are now reinstated, and given GASB 97, they'll be implemented at the same time as GASB 84 as adjusted. So it's all going to come together essentially at the same time. The question that was superseded was in the situation with defined contribution plans without a board. It was question 4.6. That will probably be eliminated in the future, probably even be rephrased perhaps in next year's implementation guide update. So what happens to GASB 32? Well, once you implement the 457 plan provisions as applicable, you could supersede GASB 32. And so in essence, GASB 97 for your June 30 year ends, you could potentially implement GASB 97 early if you implement GASB 84 early. Now, if you're taking advantage of GASB 95, no, wait until you implement GASB 84 and then implement GASB 97 at the same time. If you haven't published as of yet your December 31st 19 statements, or maybe your March 31st 19 statements, excuse me, March 31st 20 statements, and you haven't implemented GASB 84, but now you are implementing GASB 84, take a look at 97. You may be able to implement on an early basis. Now, if your government has implemented early or already, like many governments in Colorado, for example, GASB 97 will cause you to check and see if a restatement is required. Now, usually this is going to be relating to a decision made on a defined contribution or other employee benefit plan. Now, there's a reason why GASB waited until June of this year to issue GASB 97. Obviously, COVID-19 was going on, but they waited to see where governments were in implementing GASB 84. And what they wanted to do is issue the statement. Obviously, once the information was issued in an exposure draft and they got comments back and they re-deliberated, they wanted to get this out as quick as possible. So for those governments that had not issued their financial statements as of yet, they could implement GASB 97 early, implement GASB 84, and then go on their merry way and issue their financial statements. Should you implement GASB 97 early? Sure, as it may make things easier. Just be careful. GASB statements are all or nothing unless they are allowed to be implemented in piecemeal by the GASB. Now, in this case, you need to implement the things that are applicable to your government, but don't implement things piecemeal. Now, let me go back a couple of slides, this one slide here. Notice that there are multiple implementation dates. And again, the component unit provisions are immediate, and the rest of the dates are for periods beginning after June 15 of 2021. Now, if you happen to have a 457 plan that is a DB plan, which again is pretty rare, guess what? You got a transition going all the way back to GASB 68. And you may need an actuarial valuation. I'd be real surprised if you didn't have an actuarial valuation already. But if you do need an actuarial valuation, you got to go back and implement at the same time you did 68. You know, by the way, you got to bring in GASB 71 as well for your deferred outflows of resources. And that's why there's a delayed implementation date for those situations. But remember, there are multiple dates that are going on here. So how do you implement this thing? Well, as you can probably tell, it's not going to be easy. You're going to need to gather the information, including laws, regulations, trust agreements that support your decision. Now, remember, I mentioned that especially state departments of education have special reporting provisions for student activity funds. Take a look at those and see if you're in compliance first and then gap as well. Compare the proposed decisions into GASB 84 that you make. So you've gathered the information, including all these laws, regulations, trust agreements. You've made preliminary decisions in each of these activities. Now compare them to GASB 84, and in some situations, you may need to revisit those decisions. Once you revisit them, document what your decision is. Again, don't look at your neighbor. Different facts and circumstances will result in different decisions. Now, here's a way to document. Now, what you could do is use a spreadsheet or some form of database, say with 10 or 8 or 10 fields, including sign-offs. And I've seen this done multiple ways. You may want to think about bank accounts, dates of contracts, and so on. Include the sources of information for component unit decisions, whether or not there's an administrative or direct financial involvement, beneficiaries, types of beneficiaries, and other items, and document these decisions and have senior management review and agree to it. And so here, if you look at all these elements that are here, all of these elements could easily go into some form of spreadsheet or maybe even some form of database. And all these or and statements here could easily derive a conclusion depending on your skills in writing macros and so on, which are certainly beyond me. But you need to have some form of review and agreement. Again, documentation is going to be really key in this one. So let's get started. Here we have a club. Here we have 5 student leaders that determine the spending and purchasing. A teacher gives oversight as we don't want the kids to spend on things improper. We don't want them buying alcohol because they're underage or playing the lottery. There are policies at the district, but no further school board approval. The school business official invests funds overnight per school policy, but the funds are not held in trust. So let's take a look at the documentation. Here again, simple spreadsheet that I put into PowerPoint. Here we have, okay, name of activity and account information. And this, by the way, if you go back a couple of slides, this is exactly what's here. So I'm going to give it to you. So here's the name of activity and account information. Here I gave, okay, Chess Club, Nation Bank account 123456. That's important for auditing purposes. How about a component unit? Well, you know, I could go back 40 slides and bring up our component unit decision tree, the spaghetti chart. But here I'm just going to say not a component unit. Is the activity controlled by the school district? Maybe I have a drop-down box in Excel here, and here in this case I say yes. Determine if the assets are not derived solely from the government's own source revenue. I'm saying yes, they are not derived from our own source revenue. And notice the double negative. Yes, they are not. That is a double negative, again, built into GASB 84. They're not our own source revenues, not government mandated, non-exchange or voluntary non-exchange flows. No, they're not grants. Are the assets held in trust? No, they're not. Are the assets for the benefit of individuals and the government does not have the admin involvement or direct financial involvement? And the assets are not derived from providing goods or services, meaning we're not in a vendor relationship or a contractor relationship. Okay, well, I'm at a yes there. The assets are for the benefit of organizations and other governments that are not part of the reporting entity, and the assets are not providing goods or services. In this case, no. I concluded that I am a fiduciary in this situation, and it's actually not me making that conclusion, it was Jane Smith. And Jane Smith signed off on this on January 15th of this year, and it's been reviewed by Martha Jones on January 17th of this year. This is good documentation. Now, if you happen to be an audit client and you happen to have this documentation in there, I would say, no, you haven't implemented GASB 84 as of yet because you're not Martha Jones. You know, you're James Ramsey or somebody like that. So in that case, you're not Martha Jones. Okay, so here's the guidance that's available. And a lot of this is free. And so it's on the GASB's website. It's freely available, and the ones I would probably take a look at most, probably the GASB statements up here. And again, remember GASB 95 is also involved here because it delayed the GASB 84 implementation date. GASB 92, remember, amends 2 paragraphs in GASB 84, and then, of course, the all-important GASB 97. Now, the other pieces I would have in my arsenal are 2019-2. Again, be careful on this because we happen to have these 3 questions here that are deferred. And in fact, coming up in future implementation guides, you're going to get situations where these questions may be amended. So just be careful of some of that wording. Now, again, GASB 97 reinstates just 4.3 and 4.5, but not 4.6. So that question is probably going to be gone. They haven't made a final determination, but don't implement it as of yet. So with that, we do have some Q&A that is there. So we have a few questions here, and I can answer some of these. If the high school chess club is a governmental fund, does the account need to be audited, likely never done before, in order to be displayed in the CAFR? Well, if it's part of a governmental fund, chances are, yes, it needs to be audited. And in some cases, the governmental funds, there might be a law or regulation or certainly policy and procedure that requires all governmental funds to be audited, and in fact, might even require all governmental funds to be budgeted. So it really depends on government to government, but if it is a governmental fund, and if it's, say, part of the general fund, in that case, it's probably going to be audited anyway, always a major fund. Now, let's say it happens to be a separate fund, but still a governmental fund. Not a major fund, but it would be audited as part of all the other non-major funds in the aggregate. Now, here's another question here. What if the funds raised by the chess club are for a student with cancer? The board matches the funds. and they're distributed to a family within a 3-month period? That's a good question. Well, the family with cancer, first of all, in a real scenario, let's have them. Let's think about them. One of the employees who I hired when I was a preparer about 20 years ago, and he actually converted all my construction contracts into my new ERP system. He converted about 20 years of construction accounting. He just passed away a couple of days ago from cancer, and actually he did have COVID as well, and his wake is this afternoon, and unfortunately I cannot go because of COVID. So if the board matches and the funds are distributed to the family in a 3-month period, yeah, there's financial involvement there, but something, the family's outside the reporting entity, and chances are this is probably a fiduciary activity that's there because the funds are being raised, for example, like a separate not-for-profit. Now, are criminal jail cash bonds held by a county considered fiduciary activity? The bonds are contingent, held on an appearance in court. Well, yeah, I mean, it really depends on the facts and circumstances. But in this case, the bonds, if they are to be returned to the person who is a plaintiff, and throughout the judiciary process, say the county is holding those funds and then returns those funds if the plaintiff is found not guilty, that is a fiduciary activity. Now, if the funds inure over to the county after the judgment, and especially in the situation where, say, those bonds are remanded to the county and then get split maybe among various jurisdictions, well, in that case, could be a governmental activity. It really depends on facts and circumstances, and I know that there is a question, I think, in the implementation guide update on this one. So, any other questions we have, Nanette?
I haven't seen any other ones in the chat, and I think you addressed all of them that came in. So
Okay.
I think we're good, Eric.
All right, we're good. All right, so with that, again, GASB 84 and GASB 97, if you haven't implemented as of yet, and if you're a client or even a non-client, we'd like to talk to you. It's not an easy standard to implement, especially with GASB 97. Have all those tools in your arsenal. And I'm going to go back a couple of slides, Nanette. Here it is. I'm going to pull down the chat. Have all these tools in your arsenal before you go forward. Take a read to them. If you have some time in between Zoom chats, and I know we're being inundated with webinars and Zoom chats lately, if you have some time, pull this stuff down, have it in your arsenal, read it, and apply it as much as you can. So with that, Nanette, why don't you wrap us up?
Thank you, everyone, and we're going to end today's session. Thank you.
Stay healthy, everybody.